Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, October 12th, 2023. It's 1:30 p.m. Eastern Time, so I'm starting the video, and I wanted to do a quick one here. Well, not super quick, but just want to get out the things I'm watching and my thoughts on the market and where we're going and where the opportunities might be. We'll start out here with QQQ, the Nasdaq 100 tracking ETF. We made a perfect tag of that downtrend line today. Again, I'm referring to the downtrend line off the recent highs, which I'm still maintaining has remained my preferred and primary scenario that is the high in a bear market rally. And, we're most likely going to hit all these targets. Still can't rule out this alternative scenario of a marginal new and still divergent high. Anything other than that, I'm just dead wrong. This is a difference of, from where we're at today, where we hit the trend line. Again, it's not a hard number, but roughly 5, 3, it could be anywhere from, 3, almost about 4% from where we're at now, up to about 6, 7%. So it's really not, as far as the whole relative range of things, that's a 50% move off the bottom, roughly ballpark. So we're talking a relatively small margin of error. And of course, that's, just, these are my preferred scenarios. There's a myriad of other possibilities, one of which we could just grind around. Let's say, instead of just going up and then I'm dead wrong, we just grind around here for another, 6 months, a year or more. All right, but let's look at the facts. I'll show you where we're at, where my thoughts are. It's really lately starting to feel like this is it, where you have these cross currents of the economic data, really the jobs numbers still holding up. But when I look at a lot of charts out there, and more so, I'm putting more of an emphasis on the macro economics than I've ever done. It's just overwhelming. And so let me give you this in a summary. So whether I believe there's, we're going to take out these lows, and we have a lot more downside in this bear market that most likely started back in late 2021, early 2022. Marginal new high or not in QQQ and a handful of unusually large tech stocks doesn't make that not a bear market anymore. Again, you got to look at the entire market. You look at the broad-based indexes. You look at the equal-weighted indexes. You look at things like the Wilshire 5000 and the equal-weighted S&P, and that's a better gauge of the stock market. Remember, QQQ, the Nasdaq 100, although technically it is an index, it's not a balanced index. Anyone that puts their 401k or long-term money in QQQ, you might as well just put it all into Apple, Amazon, Microsoft, 5 stocks, 6 stocks, or just buy XLK, the tech sector ETF, because they mirror each other because of the unusual large weighting. And it's not just the overweighting, it's the fact that it's not a diversified sector at all. It's just the top largest 100s and the largest 100 stocks in the Nasdaq 100, and it's also exclusive of the financial sector. So it's really not representative of the U.S. economy. But at the end of the day, it's my preferred trading proxy as far as the indexes go, for the simple reason it has more juice in it. Those are tech companies, especially big tech. They're growth companies, and when the economy is growing, the stock market's going up. They go up more than the S&P 500, typically, almost at all points in time. Likewise, when they fall more as well. So that's it. It's just like I always say, you can trade gold or you can trade silver and or GDX, the gold mining stocks. If you get the call on gold right, you're just going to make more money on gold and GDX. So why tie up, more capital than you need to? Again, it's all about being right or wrong on something and then picking the security that's going to pay you the most if your call on the market or a sector or a commodity or index, whatever it is, right or wrong. All right, so most important. Sorry, I had to pause it there. I had to call someone at the gate. I had to buzz them in. All right, QQQ. All right, let's not overthink it, guys. We're at resistance, big resistance, in my opinion. That is as of now, that's the primary downtrend line off the highs, and it has plenty of reactions to help validate it. And so far, nice. I like how impulsive the reversal has been so far. When you look at the let me zoom down to the daily charts and 60-minute charts there. I'm sorry, I'm on a daily. Let me go down. Just look at it here. These were bounce targets. Let's go down to a 60. So just back here recently, I had 3 bounce targets. Remember, I've been actively traded in and out. So when that hit, I turned around, took profits there, reverse short, then went long again. I've been long and short so many times in the last couple of weeks, it's hard to keep it straight. But right now, definitely short. And for the last couple of days, pushing those shorts pretty hard. Got in a little bit early. Nothing wrong with that, unless you're stopped out. I always say I make a lot of stuff up in trade investing, and one of them is there's a big difference between being early and wrong. Being early on a trade, if you're going to, let's say, short the indexes and you think it's going to do this, or even especially this, then if you short right here and it goes to here, but your stop was here, and then it does that, then you're just early. You got in a little bit early. If you short here and it goes up to here and you get stopped out, you've now booked a loss. You're out of the position, so you're wrong. Okay, so hopefully that makes sense. And so, I'm really starting to feel that this may be it. And in fact, when I gave you the VIX yesterday, it ripped initially, then you had the Fed minutes come out, turn back around, back to where we started. But we're still, well above, the suggested stop, which was, you could put it somewhat above the support zone right here. And that's where we bought it yesterday. So you had an initial pop. And so the same holds true. There's the support zone. We're still in it. There's a big old gap right there. You're coming off a divergent low. And we just hit the QQQs, just had a nice reversal off that downtrend line. So, you keep it simple. If the Qs are going to pop that trend line, then you most likely, whether you're an active trader, maybe even a more typical longer-term swing trader, you might want to consider stopping out. And I wouldn't do it immediately on the pop. This market's full of trickery. Okay, sorry, I had to pause it again. That somebody from the pool company here doing an inspection on something on the pool, and I had to go out and talk to the guy. I'm trying to remember where I was. Pause it for a couple minutes. But either way, yeah, I like the rejection right off the trend line. I mean, that's as good as it gets right there. And I'm going to draw something in for you here that I don't have yet on this board. I have it on my futures. Nice little, you know me, I love my little divergent highs and lows. Time to get long in the divergent lows, which we did back here, and time to be short on that divergent high. And so, if you liked it here the other day or here, you got to love it here with downtrend line resistance and the rejection. That's the other thing too. I talk about that a lot, breakdowns. You can short a breakdown of an uptrend line or a breakout of a downtrend line if it's a bullish breakout. And if you miss that, sometimes you get another chance on the back test. And the problem with testing a trend line is, or back testing it, you can back test for a while. So I like to see the impulsive rejection because that helps to validate that as a significant level, and it shows that these sellers were waiting and are ready to get out, and the sellers jumped in, and there's no buyers on the other side of it, because when you have a lot more buyers in the market, supply demand, it's going to drive price up. Now, with all that being said, this may just be a little reflexive pullback off there. We had one the other day we traded. I mentioned right here, I think, for a quick pullback trade. And, so they may power up. And again, that's where you might want to put a stop. Oh, I know what I was talking about. How, there's, this market is just full of whipsaws. And I believe a lot of those whipsaws are engineered at the highest levels, those that, that can do it. If you give me $1 trillion to play with, I would have a field day, causing, initiating breakouts of potentially bullish setups and breakouts above resistance levels on securities that if I had enough visibility. So the pros can see the order flows, the number of orders. They look at the level 2 quotes, things like this, and they know if that breakout's likely to stick or not. If there's a lot of pent up demand in a stock and you have a bullish breakout, that stock usually rips and takes off from there. Then again, you have other stocks that are pushing up against resistance and momentum indicators are waning, and there's a lot of evidence to say it's not going to stick. So in other words, so if you can break out, you suck in some buyers, you squeeze out some weak-handed shorts, then you turn around and you short that breakout, short into it, expecting it to fail, and then when it does. But this one didn't fail. They don't have to have that. I'm just trying to say, if you think this is resistance and you shorted there today, or you're in there and you're stopped, give it a little bit of room because it's not unusual. It's almost more than common nowadays to pop these little levels. Look, you can see it right here. I had talked about this reaction low as being support, and that's what that was. There was a little false breakdown. Traders look at these pivot lows as key levels, so they ran it down there, sucked in some weak, late coming shorts that weren't already short, probably blew out the stops on longs, and they turned around and bought it and rode it up. That's how that works. So now that's still a big level, because even after that whipsaw, you can see we had additional reactions there. So this is what you want to watch for in more intermediate, longer term swing trading outlook. If we do reverse and make it all the way back down here, a solid break below that level, and especially that recent low now that it's been established. But I think that'll do the trick. A solid move and 60-minute close below 354 and change right there. That would most likely open the door. And then I turn my focus back to the more significant daily charts, and it would look like this. So I'm just kind of laying out a scenario here. We've had multiple tests on this level. This was a battleground, the most significant recent battleground between bulls and bears. That was a couple weeks of vigorously defending that 354.70 support, that previous reaction low there, and finally, the bears or the sellers couldn't take it down, so we had this rally. So if we go back down to it now, my guess is it'll probably crack and give way now that it's already been tested so many times and we had this rally off of there. I think that would be just a knife through the heart of the bulls that jumped in when they saw that level hold and bought this rally. However, on the flip side, if we break through here, we've got a minor, it's a pretty significant high, reaction high. It's resistance around 381.14, and that will increase the odds of this divergent high alternative scenario that I have of a marginal new and still divergent high before the big drop comes. All right. And again, anything else than that, other than that, would be, something else is going on. Futures. This is a 15-minute chart. Somebody asked me, they hadn't been able to catch up to videos and asked for a chart with some targets. I gave this one yesterday. All these are the same levels. And so what happened is this was the first level I had, and I had a very small arrow here. I'll show it to you. I'm not even logged into the site right now, so never mind. I had a break there, first arrow, first support, and every arrow break is a reaction level, and so and you, of course, you have to take out each support level to open the door to the next one. So we went down, we hit that first one, reversed right on there, bounced up, and at that point we already had some divergence forming on the PPO, but not yet on the RSI. Now we have it on the RSI, and this is again a 15-minute chart. You can see here's our divergences. We also have divergence now on the more significant 60-minute chart. So I'm going to extend that little trend line out right now. Again, this is a level right here, about 15,239, although let me show it to you on the 60-minute chart. This is really, my go-to swing trading. 15-minute charts, when we're in a volatile period and we're kind of chopping around, I'll drill down to the 15-minute charts, sometimes even the 1-minute chart, and get in and out quickly, several trades a day, long, short. But then this is bigger picture stuff. I'm probably speaking to 90% or so of the people listening to my voice now that don't have the skill sets, time, inclination to sit there and game little 1, 2, even 0.75% moves and swings in the Nasdaq 100 futures. So this is the bigger picture. This is the 60-minute chart. There's the downtrend line off the highs. There's our divergence right here on the all-important 60-minute chart. Just like on that 15, we had it forming here on the PPO. It's gotten steeper. The slope of the line, divergence line, is even steepening now. And so we still have, or had, this was a divergent high. I just have to now go like this, copy that, put it there, boom. Divergent high, and also a break of this minor uptrend line right here, forms this wedge. So if you take this trend line, it doesn't have the huge amount of reactions, but that's it. So there's the level comparable to what I just showed you, and that's where we reversed yesterday. You can see this is about 15,250, it's a pretty good level. And I think if and when it goes, that's going to open the door to more downside. We had reactions there, a couple reactions there, a distinct reaction right there. And then if you look at it yesterday, that's where that first initial pullback target was on that 15-minute chart I just showed you right there. And we hit it and bounced. And so that gives 1, 2, 3, confirm the trend line with 3 distinct reactions, took it out right here. And this would be, we're kind of in no man's land right now, that smack between support and resistance. So best thing to do, if you're looking to add to any short positions or get in short, wait for that level to go, 248 and change, 249, call it 250, somewhere right around there. 250, of course. I do have a little minor, I'll give it to you now, minor support there. And if you get down to this level and you see Apple or Microsoft, Amazon, all the above, Tesla fall into support, you have 5-minute divergences or something, then you might be able to game a little squiggle on that. But it just feels to me we're getting close to that point where this market's just about to let go, and then it's going to be more conducive to swing trading. I can't tell you, definitively yet, because look, we're just, we're just right off the highs of a recent rally for last week or so here, last couple of weeks. But, again, I think it's objective to be short. These were, that downtrend line were targets I laid out a couple of weeks ago back here when we bottomed, and that's what we hit. So it's pretty good resistance. And the fact that we had a pretty impulsive rejection off it today helps to validate it. And so that's it. I think a swing trader, and it's not too late, we are no man's land a little bit. Ideally, maybe a starter position here, stops somewhat above here. Ideally, if you can do it on a 60-minute closing basis, that helps avoid whips, like brief whipsaws where they pop it and then it reverses right away and the 60-minute candle closes back down below the trend line. And then, so this is minor support, 16164. This is much better support. This is where, and the person that asked me to give that, some near-term targets, this is where I said yesterday I have a pretty good degree of confidence we're going down to. And that is, the bottom of it's 1540, the top's 1575. I think we'd hit the bottom. I think if we get there, if I'm right, we're going to have some momentum going down into there and could even carry down slightly below it. So that would be from where we're at today. It's nothing huge, but it's another 1.7% or so drop from where we're at right now. And then, but I already gave you bigger picture stuff, what it does. I know sometimes I get kind of tied up, or it seems like I'm tied up in the world of this micro analysis. I calling these little squiggles, zigs and zags. But you get down there and it's going to be comparable on QQQ to this level right here, about 362-ish right there. So that's that target. I could even, those are the bounce targets. Disregard that. T3 first of 372 or downtrend line. So this would be my first swing. If you don't want to, game the little squiggle there and halfway down, about 362 right there. If that breaks, remember, this was a period of consolidation and a pretty significant one. Nice, clean, and there you had a breakout right there. So if you are bullish and looking for new highs, and we do go down, and this wasn't just a little blip off the trend line, we do that right away. If we go down there, that's where the bulls, quote unquote, should be stepping in. And if they don't, and I suspect that that level will give whether we have a decent bounce off it or not. If it breaks way, then that's not good, because we already had this trading range and we broke to the upside. So at most, again, speaking for the bullish scenario, at most we should have a back test and then take off. If they smash through there, and then especially if they take out the recent lows, it's very simple. The odds shoot up significantly that we're going to go down and hit my additional. Oh, I'm on a 60. Those additional targets here I gave you weeks back on QQ2. T1 was already hit right here. So then T2, T3, T4, T5. You still have the 200-day moving averages that weren't tested yet on QQQ. SPY, you did have the 200 days successfully tested. This is SPY. They're the blue lines, the 200-day simple moving average. Red lines, the exponential. So SPY already checked that. And SPY also, if you look at this is kind of a busy board. they're both busy, but let me just highlight for you what I see. This is the low right there, where bulls think it's the end of a bear market that we had. I think it's the end of the initial leg down in a much, much larger bear market that's coming, or it's already underway. That's October 15th lows. We had a nice clean reaction there. Danced on it a couple of days there. Breakdown, back test 1, back test 2, now a rejection right there. And then I go to this other board and I showed you, I know it's gotten busy because there's just so many things in the technicals that I see. We had a DH is divergent high, BEC is bearish engulfing candle, just like you had a bullish engulfing candle at the low on October 15th. They marked tops and bottoms. You have this potential head and shoulders still in play, left shoulder, head, right shoulder, and your neckline. I have an upward sloping neckline, perfectly normal in those patterns, and a breakdown and a back test of the neckline. And the measured target comes in down here, although I have a price target or support level a little bit above that about 416.30. Okay, so that's it. That's the market in a nutshell. Market leading stocks, Apple, most important thing, remember the other day I showed you on the 60 and dailies, Apple has both price resistance, really good resistance of just above 180 right there, plus the downtrend line. It is far from mere coincidence that the downtrend line off the highs in Apple coincides with the one in QQQ, Apple, of course, being the largest component. Microsoft's interesting. Microsoft also has a downtrend line off the high, again, not by mere coincidence, and it's slightly above it. Made a breakout yesterday, not very impulsive or convincing, but it's still on there, so you got to give it points. Watch this closely. If that fails, this breakout, then that's going to be bearish. That's a false breakout, aka bull trap. Now, Microsoft, just like Apple, is coming off a divergent low. So again, I cannot write off those new marginal new high scenarios. But I'm showing you right now that we're at a lot of stocks have failed at resistance. Microsoft right here, there's this 60-minute chart. Apple, this is a 60-minute chart. Last update I gave you, I told you right here was a resistance zone with the downtrend line just above. And then, so watch these uptrend lines right there on Apple, Microsoft. It's not as clean. I'll put one there right there. Alphabet, I'm on a 60-minute chart. Alphabet's got a really nice one here. This is really a very bearish chart. That's why I'm ready to morph back into, I know a couple weeks ago I told you I was probably going to morph back into swing trade mode, and then I just saw too many opportunities to gain bounces, so I got long, short. But this is, again, it just, to me, it looks ripe and ready to break. This is a giant bearish rising wedge. It's textbook, beautiful. Breakdown was impulsive, the gap down below it. And as I said earlier in the video, sometimes you break down below a trend line and that's it. You never look back. Other times, in this case, you never took out. I have a purple line that was and still is, to me, the kind of all-in moment. I'm waiting for these purple lines on these big Magnificent 7 to go, these purple support levels. On Alphabet, it's 127.15. So we gapped down, we hit it. It was tremendous support. I mean, tremendous. We had a trading range there. We got rejected there to validate again. Then we had a breakout to all-time highs. Then we consolidated in another range. So that's a 10 on a scale 1 to 10. So it's really no surprise that we did bounce. And then the bounce formed this little smaller wedge under the trend line and the primary trend line. And now we're back testing. So I'm going to, if I don't already have it, I'm going to do it right now. Set a price alert on this little sucker here because that would be a pretty decent sell signal. So here we go, set alert. Boom. Okay, so we break that. As I like to say, the redder the better. I want to see a big red candle down through there, a solid red close, take out this support level, and then the lights out level, 127.15. They all have to go. Microsoft's 311.50, we'll call 311. Apple's first one's at 170 and then 166 change. Amazon should populate right there, 123, very important level. Also below that is the 200-day exponential moving average. Then you have the 200 simple down here. Look how well that lines up. So we go down here, we pop 123, we take out the 200-day, we'll probably run down to the primary uptrend line and then the 200 simple. So the exponential moving average is right there. And then if that goes, that's all lights out. I probably should color this up purple too. All right, let me do that. All right, so we can do this over and over. These are the same levels I've given you. Nothing's changed on the purple lines that need to go. So again, I just can't get overly like lights out from the market bearish until these levels go again and really take away that I told you. When I can, I'll rule out that marginal new divergent high scenario. There's your minor uptrend line. So all these big fangs, here's a common theme, guys. All these big fangs, as I'm going through them, that are now called Magnificent 7, they all have these little minor uptrend lines that might not look like much, but when they break, they should send us down to the next support levels. And then if and when those support levels go, then boom, boom, boom. There's even one in Tesla. Look at that. They all have them. All right, guys, that's it. And we're at those levels now. So I need to stop this video, get it out to you. And like I said, if you're, I don't need to tell you what to trade, what to buy. The VIX has a lot of potential. If these things crack, I think this market's been sitting on, it feels very heavy. And the last takeaway is, look, maybe not. I know most people don't like bearish predictions. Most people don't like shorting stocks. They don't know how to do it. They're not comfortable with it. And like I always say, you have to be Johnny on the spot. You cannot be the last guy or gal to leave the party when you're short selling. You got to get out when it's time, because once those, the correction of that drop has run its course, the counter trend rally, especially in a bear market, will exceed most people's loss limitations or give back. So I mean, if even talking about the initial leg down last year, most people can't tolerate. And we were long every one of the counter trend rallies, but they were 17%, 24%. So to get from point A to point B, very few, myself included, I'm not going to sit through a 17% or 24% give back rally. And so that's why I do actively trade. And that's what this site's all about. It's about swing trading and trying to catch these, swings in the market, up and down. And so that's it. So I think at some point here, we already broke the primary uptrend line. We just got rejected at the downtrend line. And at some point, I think we're going to get back to where we're in impulsive selling mode. So far, it's more of an orderly correction, stair-stepping down right off the highs. Nobody can argue that the trend isn't currently bearish. But this starts to pull it into question, because there's your downtrend line. There's your, your downtrend right here. So it would just be ideal for the bearish case to see this rejection stick and to go out and then undercut those lows like I talked about. And if and when we do, not only is it going to keep this downtrend intact, but it's going to start to make the bulls say, maybe this isn't a correction. Maybe it's something, start of something more. Who knows what they're thinking, but I can tell you there's going to be a lot of stops that are going to be hit. A lot of long side traders, and they rightfully should have stops below here. So that's what could cause a pretty swift move down. And maybe it's at what I call point of recognition, where they realize, oh, maybe this is something more than just a little corrective wave. All right, guys, I can't rule that out yet. You know me, my positioning is kind of day by day lately. Short as of now. The levels that start to change that for me. So let me wrap it up, get the video out to you, and then I'll do another one later today, maybe cover some of the other things I'm watching. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.